What if I told you that a single phone call or a simple form filled out at the wrong time could cost you over $100,000 in retirement? Every single day, thousands of Americans make irreversible mistakes with their Social Security benefits. They do it because the rules are confusing, the government doesn't offer personalized advice, and the rumors you hear from friends are usually wrong. Today, we are getting straight to the point. We are going to break down the 5 most devastating Social Security mistakes retirees make and exactly how you can avoid them to maximize your monthly checks. No fluff, just the facts you need to secure your financial future. Let's dive right into mistake number 1. Mistake number 1 is the most common, claiming your benefits the exact second you turn 62. Yes, 62 is the earliest age you can claim your Social Security retirement benefits, but doing so comes with a massive permanent penalty. If your full retirement age is 67 and you claim at 62, your monthly check is permanently reduced by 30%. Let's put real numbers to this. If your full benefit is supposed to be $2,000 a month, claiming at 62 drops that check to just $1,400. That is a $600 loss every single month. Over a 20-year retirement, that one decision costs you over $144,000. Now, I understand that some people have to claim early due to health issues or job loss. If you need the money to survive, take it. But if you are still working or you have savings to live on waiting until your full retirement age or even age 70 is one of the best guaranteed investments you can ever make. Your benefit grows by 8% every single year you delay past your full retirement age until age 70. You will not find a guaranteed 8% return anywhere else. Mistake number 2 is falling into the earnings limit trap. Many seniors think, I will claim Social Security at 62, but I will keep working my normal job to double my income. If you do this before reaching your full retirement age, the Social Security Administration will penalize you. It is called the earnings test. For roughly every $2 you earn above the annual limit, which is usually around $21,000 to $22,000 depending on the year, the government will withhold $1 of your benefits. Let's say you make $40,000 a year at your job, but you also claimed Social Security early because you are thousands of dollars over the limit. The government could withhold your entire Social Security check for half the year. Now, technically, this money isn't lost forever. Once you reach full retirement age, the government recalculates your benefit to slowly pay you back over time. But most seniors don't know this rule. They expect a full paycheck and a full Social Security check, and they end up with a massive cash flow crisis when the government suddenly stops sending their monthly benefits. If you plan to keep working full-time, it almost always makes mathematical sense to delay your claim. Moving on to mistake number 3, ignoring spousal benefits. This mistake leaves billions of dollars on the table every year, particularly for stay-at-home parents or spouses who earn significantly less than their partner. Here is how the rule works. You are entitled to either your own Social Security benefit based on your work history or up to 50% of your spouse's benefit at their full retirement age, whichever number is higher. Let's say a husband's full benefit is $2,600 a month. The wife didn't work outside the home much, so her own benefit is only $600 a month. She doesn't have to settle for $600. Under the spousal benefit rule, she can step up to half of her husband's amount, bumping her check to $1,300 a month. And here is the secret many people don't know. This applies to divorced spouses too. As long as you were married for at least 10 years and you are currently unmarried, you can claim benefits based on your ex-spouse's record. It doesn't reduce their check, and they don't even have to know you are doing it. Do not leave this money with the government. Mistake number 4 is incredibly difficult to talk about, but it is financially vital. Mismanaging survivor benefits. When a spouse passes away, the surviving spouse is allowed to keep the higher of the 2 Social Security checks, while the smaller check disappears. This means your household income is going to drop. But how you claimed your benefits while both of you were alive directly impacts the survivor. If the higher-earning spouse claimed early at 62, they permanently locked in a smaller check. When they pass away, that smaller check is exactly what the widow or widower is stuck with for the rest of their life. The best strategy for married couples is usually to delay the higher earner's benefit as long as possible, ideally until age 70. This ensures that when one spouse eventually passes away, the surviving spouse is protected by the absolute largest monthly check possible. It is not just about your retirement. It is about protecting your partner's final years. Finally, mistake number 5, assuming the government's math is perfect and never checking your own earnings record. Your Social Security benefit is calculated based on your 35 highest earning years in the workforce. But what happens if an old employer misspelled your name on a W-2, or a company went bankrupt and failed to report your income in 1998? The Social Security Administration will record a 0 for that year. Just 1 or 2 0 years factored into your 35-year average can pull your monthly benefit down significantly. You need to go to SSA.gov, create a free My Social Security account, and download your statement today. Review every single year of your recorded earnings. If you see a 0 where there should be income, you can submit old tax returns or W-2s to fix the error. But if you wait until you are already claiming benefits, it is often too late to fix. Navigating retirement isn't easy, but avoiding these 5 mistakes puts you far ahead of the average American. If you found this video helpful, please hit the like button so this information can reach other seniors who need it, and subscribe to the channel for more direct, no-nonsense financial strategies. Want to know exactly how much money you can safely withdraw from your savings each month without going broke? Click the video on your screen right now, and I'll walk you through the exact math. See you there.